There are 9 states in America that do not tax what you earn: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, Wyoming. New Hampshire is the newest member of that list. It used to tax interest and dividend income. That tax was repealed for income earned from January 1st, 2025, which means New Hampshire now taxes no form of income at all. 9 states. And every single one of them still has to pay for roads, schools, courts, prisons, water systems, and a state government. The money comes from somewhere. So here is the number that started this video. Across the United States, the lowest earning fifth of families pay 11.4% of their income in state and local taxes. The middle fifth pay 10.5%. The top 1% pay 7.2%. That is the Institute on Taxation and Economic Policy, and their finding is blunt. In 41 states, high-income families are taxed at lower rates than everyone else. ITEP also ranks every state by how upside down its tax system is. The 10 most regressive in their order are Florida, Washington, Tennessee, Pennsylvania, Nevada, South Dakota, Texas, Illinois, Arkansas, and Louisiana. 6 of the 9 states with no income tax are on that list. Florida is number 1 on it. In Florida, low-income families pay almost 5 times more of their income in state and local tax than the wealthiest households do. ITEP explains the mechanism plainly. 8 of those 10 states draw more than half their tax revenue from sales and excise taxes, against a national average of about a third, and 6 of them do not levy a broad personal income tax. That is the whole video. 9 states made the same promise. Every one of them had to get the money somewhere, and where they got it from decides whether the promise was worth anything to you specifically. We are counting down from 9 to 1 by how hard the replacement bill actually lands, every figure on screen with its source as it is spoken. Where a number comes from a commercial estimator instead of a government, it gets labeled an estimate every time. And number 9 is the state where the promise mostly holds up. That matters because a countdown that only prosecutes is a list of insults with a map attached. Wyoming has no income tax. It also has one of the lowest overall tax burdens in the country. And this is the one state on the list where you can stop looking for the catch in the way you're expecting to find it. Combined state and local sales tax averages 5.39%, which is 44th out of 50. The national population weighted average is 7.53%. Property tax runs around 0.56%. There is no corporate income tax and no estate tax. So who is paying for Wyoming? Wyoming's own revenue forecasters publish the answer twice a year, and I went and got it. For the 2025 to 2026 biennium, severance taxes on minerals bring in $667.9 million. Federal mineral royalties add $420.8 million, against a total general fund and budget reserve account of $4.29 billion. So minerals coming out of the ground account for roughly a quarter of that account directly. And look at the largest line, because this is the part that surprised me. The single biggest source is investment income, $1.44 billion, more than double the severance tax. Wyoming is not funded by the minerals it digs up this year so much as by the savings account it built out of the minerals it dug up in previous decades. Which brings us to the counterweight, and every state in this video gets one. Wyoming's model is a bet, and its own forecasters say so in writing. Their words, Wyoming's state revenue streams are volatile, and that characteristic, given reliance on energy and financial markets, is unlikely to abate. The strain is already in the numbers. Wyoming's total natural gas production in 2024 ran at 52.8% of the peak it set in 2009. And it has declined in 6 of the last 8 years. Severance taxes from oil recently made up 54 to 55% of all state severance tax collected, more than double any other mineral, which means the whole structure now leans on one commodity. And in 2025, the legislature cut the coal severance tax rate from 6.5% to 6%. A state does not cut the tax rate on an industry that is thriving. There's also the thing the tax table cannot show you. Wyoming is the least populous state in the country. That low tax bill buys a genuinely thin layer of services, long drives to hospitals, and winters that are a real variable in the decision. So Wyoming is number 9 because the promise is close to honest. You're getting a low total bill, and you're getting it because of geology. The next state does something stranger. It does not just decline to tax you, it sends you a check. Alaska has no state income tax and no statewide sales tax. It is the only state on this list with neither of those, and then it goes further, because once a year, Alaska pays its residents money. The permanent fund dividend, $1,000 per eligible resident, plus a separate $200 energy relief payment funded in the same budget. And the story of how that number got set is the segment. The Alaska House Budget Panel advanced a draft dividend of $3,800. The full House passed a budget with $1,500. The Senate signaled it wanted less. A House and Senate Conference Committee settled the $13.9 billion operating budget on a 4-2 vote, and the dividend landed at $1,000 with the $200 energy payment attached. One number, 4 different values in a single legislative session. The dividend is not a constitutional entitlement at a fixed amount. It is a line in an annual budget fight, and it has been shrinking. Now the bill. Alaska has no statewide sales tax, and local governments are permitted to levy their own. The population-weighted average of those local sales taxes is 1.82%, which is 46th of 50. The real cost is not on the tax table at all. Alaska imports most of what its residents consume across a very long distance to a small market that shows up in groceries, fuel, heating, freight, and construction, and it does not appear in any line item you can look up in a state statute. The honest way to say it is this: you receive a check from the state, and then you hand a large part of it back at the grocery store and the fuel pump. Whether you come out ahead depends entirely on which community you live in and how much of the year you're heating a building. And that gap inside Alaska is enormous. The tax picture for someone in Anchorage on the road system and someone in a village supplied by barge and small plane are not the same calculation, and any video that gives you one Alaska number is lying to you by averaging. Number 8, then, a state that pays you in a place where the money buys less. The next one keeps its sales tax modest and then applies it to the one thing you cannot choose to stop buying. South Dakota has no income tax, and on the sales tax table it looks unremarkable. 6.11% combined, 36th out of 50, comfortably under the national average of 7.53. That rate is not the mechanism. What the rate applies to is the mechanism. South Dakota taxes groceries. Food is taxed at a temporary reduced state rate of 4.2%. That reduction is scheduled to expire, which returns the rate to 4.5% in 2027. And the state has now tried 3 times to stop that happening. A bill this year, Senate Bill 195, would have removed the expiry date and made the lower rate permanent. It died on the Senate floor on a 17-17 vote and never reached the House. Identical legislation failed in 2024 and again in 2025. So the increase is not a proposal, it is scheduled, and 3 attempts to cancel it have failed. Here's why taxing food is different from taxing anything else, and why ITEP puts South Dakota 6th on its list of the most regressive tax systems in America. Every household buys food. A household on $30,000 a year and a household on $300,000 do not buy 10 times as much of it. Food is close to a fixed quantity, which means a tax on it takes a far larger share of a small income than a large one. That is the whole definition of a regressive tax, and a grocery tax is the cleanest example of one that exists. Nationally, ITEP finds the lowest earning fifth of households pay 7% of their income in sales and excise taxes alone. The counterweight, and South Dakota's is real. Total tax burden in South Dakota is genuinely low. The state has no corporate income tax, and property taxes sit in the middle of the national range rather than at the top. If your income is comfortable, South Dakota is close to the deal it advertises. The state legislature has also been actively trying to cut the grocery rate, which is more than most of the states on this list can say. The regressive part is not an accident of drafting. It is what happens structurally when a state removes the tax that scales with income and leaves the taxes that do not. Number 7, the next state taxes. Something you also cannot easily give up, and it taxes it again every 12 months based on what it cost when it was new. Nevada has no income tax. Nevada's promise was that visitors would pay for the state instead of residents, and for a long stretch that mostly worked. Combined sales tax runs 8.24%, 13th highest in the country. That is the visible half. The half people moving to Nevada consistently do not see coming is the car. Nevada charges an annual governmental services tax on vehicle registration, and it is not a flat fee, it is a tax on value, and the value it uses is not what your car is worth. The governmental services tax is 4 cents on every dollar of the DMV's valuation. That valuation is 35% of the vehicle's original manufacturer's suggested retail price, depreciated 5% after the first year, then 10% a year after that, down to a floor of 15%. The number that matters in that paragraph is original. The tax follows what the car cost new for as long as you own it. A new $40,000 vehicle owes roughly $560 in governmental services tax plus the registration fee. That same vehicle at 10 years old owes about $84. Clark County, which is Las Vegas, and Churchill County add a supplemental cent on top. That example is arithmetic from the published formula, and it is labeled illustrative, because your figure depends on your exact vehicle and county. Think about who that structure charges hardest, a household that recently bought a newer vehicle in a state with limited public transport and long distances, where owning a car is not optional. Nevada is 9th on ITEP's list of the most regressive tax systems in the country. The counterweight, Nevada's tourism base is genuinely enormous, and it genuinely does carry a large share of the state's revenue that residents in most states would be carrying themselves. If you rarely buy vehicles and you live somewhere you can walk, Nevada's deal is good. The exposure is the same shape as Wyoming's, a revenue model resting on one industry is only as stable as that industry. And Nevada found out exactly how that feels the last time visitor numbers stopped. Number 6, the next state has no income tax and no sales tax either, and it pays for everything with a single bill that arrives at your house. New Hampshire is the only state in this video with no income tax and no sales tax. 0% sales tax. And since the interest and dividends repeal took effect, no tax on income of any kind. So New Hampshire has removed both of the two taxes most states lean on. The money still has to come from somewhere, and in New Hampshire it comes from one place with an intensity that has no parallel in the United States. Property. The New Hampshire Fiscal Policy Institute puts it exactly like this. Property taxes account for about 63% of all state and local tax revenue in New Hampshire, and property taxes account for a greater share of state and local government revenue than in any other state. 63% of everything from one tax on one asset. And now the number that made this state number 5 instead of number 8. Because New Hampshire funds itself at the town level, the rate is set by your municipality, which produces the same $500,000 house in one New Hampshire community, an annual property tax bill of about $1,310, in another more than $18,270, 14 times the bill, same house, same state, same year. That is not a rounding difference between regions of a large country. That is a single small state, and the variable is which side of a town line the building sits on. I want to be precise about something. NHFPI's analysis does not name those two communities, so I'm not going to name them either. And nothing you see on screen in this segment is labeled as the $18,000 town. What the study establishes is the spread, and the spread is the finding. New Hampshire's effective property tax rate on owner-occupied housing runs about 1.50%, 5th highest in the country. The counterweight, and this one is genuinely strong. New Hampshire's total tax burden is not high by national standards, and for renters, the arithmetic can be excellent because the sales tax you're not paying is 0, and the property tax you're not paying directly is somebody else's line item. New Hampshire also consistently scores well on the measures people actually move for, and the town-by-town funding model is a deliberate political choice about local control rather than a mistake. The practical instruction is the one thing to take from this segment. In New Hampshire, the state level number is close to useless to you. Number 5. The next state has the second highest sales tax in America, and it charges it on your groceries. Tennessee has no income tax on wages, and Tennessee has the second highest combined sales tax rate in the United States, 9.61%. Only Louisiana is higher, at 10.13%. The national population weighted average is 7.53%. So on every taxable thing you buy in Tennessee, you're paying roughly 2 cents more on the dollar than the average American. And Tennessee taxes food. Groceries get a reduced state rate of 4%, with local rates of up to 2.75% on top of it. ITEP ranks Tennessee the third most regressive tax system in the country, behind Florida and Washington. Here is the arithmetic that the phrase no income tax hides in a state like this. A household earning $50,000 a year spends most of what it earns, and it spends it locally on taxable things. A household earning $500,000 saves and invests a large share of what it earns, and savings are not subject to sales tax. Removing the income tax and raising the sales tax does not remove a burden. It moves the burden onto the households that spend all of their income, which is the definition of the bottom of the distribution. That is the same mechanism as South Dakota's grocery tax, running at nearly double the rate in a state with 6.9 million more people. The counterweight. Tennessee's property taxes are genuinely low by national standards, and for a household with substantial income and modest consumption, especially a household that has already bought its house, the Tennessee deal is real and it is large. That is a specific profile, and if you're in it, the state delivers exactly what it advertises. The catch is that the state's tax system is calibrated so that the further you are from that profile, the worse the trade gets. Number 4, and now the state, most of the people watching this are actually considering. Texas has no state income tax. It is the single most quoted fact about moving to Texas, and it is completely true. Texas also has one of the 10 highest property tax rates in the United States. 1.40% effective rate on owner-occupied housing value, 7th highest in the country, against the national benchmark of 0.90%. And Texas collects $5,737 per person in combined state and local tax. Combined sales tax runs 8.19% on a 6.25% state rate. So the sentence that describes Texas is the one from the last video, and it has not improved with age. The state does not tax your income, it taxes the thing you moved there to buy. There is a second order effect here that catches people who did the arithmetic once and then stopped. A property tax is a percentage of an assessed value, and in a fast-growing Texas market, that value climbs. Which means the bill is not a fixed cost. You can plan around the way you can plan around a rent payment or a mortgage principal. It is a cost that grows with the thing that made you feel good about buying. ITEP ranks Texas 7th most regressive in the country. The counterweight, and Texas has 2 real ones. Texas homestead exemptions reduce the taxable value of a primary residence, and the appraisal cap limits how fast the assessed value of a primary residence can rise in a single year. Both of those genuinely soften the curve, and both of them are the reason the effective rate a long-term Texas homeowner actually pays can sit well below the headline number. The second counterweight is that for a high earner, the arithmetic still wins. Somebody moving from a state with a high income tax rate onto a Texas salary can be substantially better off even after the property tax, and pretending otherwise would be its own kind of dishonesty. The people the trade goes badly for are the ones with a large house relative to their income. A retiree on a fixed income in an appreciating neighborhood is the clearest case, because the income does not move and the assessed value does. Number 3, the next state's replacement bill is not a tax at all, which is exactly why it does not show up in any comparison you have read. Florida has no income tax, and Florida has the most regressive tax system in the United States. That is not a ranking of how high Florida's taxes are. It is a ranking of who pays them. In Florida, low-income families pay almost 5 times more of their income in state and local tax than the wealthiest households do. First out of 50. And the strange part is that Florida's sales tax is unremarkable. 6.98%, 28th of 50 below the national average. So where is the money coming from? The largest bill attached to living in Florida is not levied by the state of Florida. It is home insurance, and Florida's is the highest in the nation. I'm going to be careful here because this is the number the whole internet quotes and nobody sources. Insurance.com puts Florida's average annual premium at $7,136 for a standard policy at $300,000 of dwelling coverage against a national average of $2,543. roughly 2.8 times the national figure. Insurify puts Florida's 2025 average at $8,292 and projects a further 2% rise to $8,458 by the end of 2026. Those two figures disagree by well over $1,000. Within Florida, the spread is larger again, with typical premiums reported around $3,200 to $4,500, and coastal South Florida properties running from $5,800 upward. The second bill is homeowners association fees, and here I have to tell you what I do not have. HOA fees are set by tens of thousands of individual associations and are not centrally reported by any government agency in the United States. There is no defensible national or statewide average for me to put on screen, so I'm not going to invent one. What is documented is the direction, and it is the single most common complaint from Florida homeowners right now, alongside insurance: the counterweight. Florida's property tax includes a homestead exemption and the Save Our Homes assessment cap, which limits annual increases in assessed value on a primary residence. A long-term Florida homeowner can be paying very substantially less than a recent buyer next door on an identical house. For a high earner arriving with a large income and buying modestly, Florida's headline deal is still a real one. The trade goes badly in a specific and now very common case: a household that buys near the coast at current prices and then discovers that the line item nobody quoted them is larger than the property tax and rises faster. Number one is the state that made the same promise as the other 8 and has already started taking it back. Washington has no income tax. Washington is also the second most regressive tax system in the United States, and it has the third highest sales tax and the third highest gas tax and a capital gains tax, and as of this year, a law on the books that taxes income. Let us take those in order. 9.57% combined sales tax, third in the country behind Louisiana and Tennessee, then fuel. On the 1st of July 2026, Washington's state gas tax rose 1.1 cents to 56.5 cents a gallon. Diesel went to 59.5. That increase was the first of the automatic annual inflation adjustments required by a law passed in 2025, which means it is now scheduled to rise every year without a further vote. Federal tax adds another 18.4 cents on top. Only California and Pennsylvania tax fuel more heavily than capital gains, because Washington already taxes one kind of income and has since 2022. The first roughly $278,000 of long-term capital gains are exempt above that 7%, above $1 million, 9.9%. And then the thing that put this state at number one, on 30th of March 2026, Washington signed into law a 9.9% tax on income over $1 million, beginning in tax year 2028, collected in 2029. Now I want to be exact about what that is and is not, because this is where every other video on this subject would overreach. That is a millionaire's tax. It applies to income above $1 million. If you are watching this and planning a move to Washington, the overwhelming probability is that it will never touch you personally. And anybody telling you Washington just introduced an income tax on you is selling you something. What it is a precedent. Washington is one of 9 states whose entire relocation pitch rests on the words no income tax, and Washington has now enacted a tax on income. The promise those 9 states make is a policy, and a policy is a thing a legislature can change. 8 states have not changed it yet. The counterweight, and Washington's is substantial. Washington's economy pays extremely well for a high earner in technology, aerospace, or healthcare. The absence of a wage income tax on a Seattle salary is worth an amount of money that no sales tax rate is going to claw back. That is a genuine, large, calculable benefit, and it is why people move there. The regressivity finding and that benefit are the same facts seen from 2 ends. A system with no wage income tax and very high consumption taxes is excellent for a household with a large income and mediocre for a household without one. ITEP ranks it second most upside down in the country because that gap is unusually wide in a state that is unusually expensive. Number 1, because Washington charges the heaviest combined replacement load of the 9, and because it is the first of them to demonstrate that the promise has an expiry date. 9 states, every figure sourced, everyone given its defense. Here's what I came away with having built this No income tax is not a description of how much a state costs you, it is a description of which tax the state chose to remove. And every one of these 9 states replaced it with something. Wyoming replaced it with coal and gas, Alaska replaced it with distance, South Dakota and Tennessee replaced it with your groceries, Nevada replaced it with your car, New Hampshire and Texas replaced it with your house, Florida replaced it with a bill that is not even a tax, Washington replaced it with all of the above, and has now started replacing it with a tax on income. Which means the headline rate is the wrong number to move on. The right number is your total bill for your household in your specific town. And that calculation has 4 inputs that almost nobody runs before signing. 1. The property tax rate in a specific municipality, not the state average, because New Hampshire's 14 times spread exists in milder form in every state on this list. 2. An actual insurance quote on the actual address before you make an offer, not a state average, the address. 3. The sales tax rate and whether the state applies it to food. 4. What it costs to keep a vehicle registered there every year. Run those 4 and you will get a number that is yours. It might well still favor the move. For a lot of people it does. And this video is not an argument that it does not. It is an argument that the phrase no income tax was never the answer to the question. It was the answer to a different, easier question, and it got repeated until it sounded like advice. If you want the other half of this, it is the one nobody in this genre will make. There are states that do tax your income where the total bill for an ordinary household lands lower than in several of the 9 you just watched. That is the next one, and I will run the same 4 numbers on every state.